Now, one of my favorite economists on Wall Street keeps saying it looks okay until it isn't. And if you look back at 1991 and 2007 and so forth, all the data that we're looking at now, like employment, consumer spending and everything, all of a sudden looks great and then it stops. Are we close to that moment where all of a sudden the consumer says, hey, time out, I don't feel very good about the situation, sentiment is plunging, credit card debt delinquencies are rising at the fastest rate in 30 years. At what point do they actually begin to pull back? I mean, do you think we're close to that?
Well, it's so funny you say that, too, because it's like, I don't know, this episode of Seinfeld where Jerry Seinfeld gets good news, then he gets bad news, like even Steven. And it feels like, delinquencies, bad news. Good news, stronger GDP print. We keep going back and forth. And you're right, everything kind of looks pretty good. But then all of a sudden, you had the 2008, 2009 moment, which I hope you don't have. But the rising interest rate is definitely hurting the housing market. Mortgages over 8%, credit cards over 20%. I mean, they have an impact. So the Federal Reserve, yeah, they raised short-term rates, but the rest of the market said, let me take it from here, and they started bidding up and raising interest rates. So that's really the overhang we've had for the last couple of weeks, Nancy, as you know, is the Treasury yields going higher, offer competition to stocks, and while the earnings are pretty good, they're not like, solid beats where you say, okay, we can get away with a 5%. Instead,
right.
We have multiples contracting a bit here because of these higher rates.